Arizona's real estate world just got shaken. A Florida developer was just held liable in an Arizona court for $296,448,624 in lost profits after a broken real estate deal. That verdict, delivered after a 12-day trial, is not just a legal headline, it's a warning shot to developers, investors, and homeowners across the state. This verdict confirms that when deals fail in Arizona, the stakes are enormous, and the financial fallout can be massive. But what does it really mean for the Arizona housing market as we head into 2026? That's what we'll unpack in this video. How this case parallels broader risks in Arizona, where the legal, financial, and development currents merge, and what you need to know if you're investing, building, or buying in the state now. The plaintiff's argument centered on lost profits. They claimed the developer breached a contract, derailed construction or delivery, and deprived them of gains they would otherwise have earned. The jury agreed. The defendant's failure, whether through delays, mismanagement, or contractual missteps, has been judged costly. In Arizona's fast-moving housing environment, contracts, obligations, and development timelines matter more than ever. A miscalculation, a delay, or a broken promise can turn a six-figure deal into multi-million losses. That legal risk is underappreciated in many real estate conversations. They focus on market factors and ignore litigation exposure. But in a state experiencing rapid growth and volatility, legal risk becomes part of the investment equation. Let's zoom out and see how this verdict ties to broader patterns in Arizona. Over the past few years, developers have raced to build new housing to keep pace with demand. But supply chain issues, labor costs, permit delays, and interest rate swings have all increased project risk. Many projects that looked profitable on paper are now stretched. The legal verdict reminds developers and investors, you must build guardrails into every contract, risk share smartly, and anticipate worst-case scenarios. The case also serves notice for joint ventures, land option agreements, and equity partners. When you partner on a project, your contract must clearly define exit rights, default terms, performance benchmarks, and damages thresholds. Otherwise, one failed phase or one misstep could trigger massive liability, as this verdict demonstrates. What does this mean for Arizona's market going forward? First, financing will get tighter. Lenders and investors will demand stronger legal protections, more conservative projections, and deeper reserves for litigation risk. That means fewer speculative deals, more scrutiny, and higher costs for developers. That will slow supply growth, which could help support home price stability in many markets, especially if demand holds. Second, developers will shift toward less risky projects, smaller scale, phased delivery, mixed uses, or properties that can be converted. Flexibility will be a premium. Projects that can pivot, say, from condos to rentals will have an edge. Third, consumer caution will rise. Buyers and investors might demand stronger warranties, escrow protections, or holding periods before transfer. Real estate contracts will evolve. You'll start seeing more performance bonds, penalty clauses, and legal shields in residential agreements. What was once common in commercial development will begin creeping into home purchase deals. Let's turn to the buyer and seller side. For sellers, this case is a reminder. Title, deliverable condition, zoning permits, and contract clarity matter as much as curb appeal and market timing. If a seller misstates conditions or fails to disclose delays, they can face legal blowback. That increases risk in listing terms, disclosures, and timelines. For buyers, it's a call to due diligence. Before you sign, verify project status, building permits, developer track record, contingent clauses, and milestones. Legal recourse exists, but often too late to prevent financial damage. Smart buyers will demand escrow protections or contingency periods tied to completion benchmarks. In Arizona's fast growth zones, suburbs around Phoenix, Scottsdale, Mesa land option deals, master planned communities, and speculative building are common. This verdict will cause developers to re-inspect how they structure those deals. Some land sellers may insist on higher upfront equity or tighter penalty terms. Developers may demand longer option periods or more flexible exit rights. Another dimension, this case heightens the importance of political risk and regulatory change. If a city or county changes zoning mid-project or delays infrastructure, that's not just a delay, it could trigger legal exposure. Developers will push for stronger governmental indemnities, better risk sharing with municipalities, or more supportive local policies. From a capital market view, investors will compare Arizona against jurisdictions with weaker legal environments. Some may demand higher returns for investing here to absorb the possibility of judgments like this. That could raise required yields, lowering valuations or margins for development deals. But not all is bleak. This verdict also acts as a market cleanser. Deals built on shaky assumptions, weak contracts, or optimistic timelines will be weeded out. The survivors will be stronger, more disciplined, and legally fortified. That could lead to healthier long-term growth in Arizona's housing. For the average homeowner or investor watching this, take this as a signal to raise your guard. Don't assume every contract is standard. Ask about contingencies, penalties, performance milestones, and legal protections. When building, choose developers who demonstrate strong legal and financial discipline. When buying pre-construction, insist on clear escrow and guarantee terms. Finally, timeline matters. If you're investing now, do it with eyes wide open. Next year, some jurisdictions might begin adjusting rules, requiring more disclosure, tighter performance bonds, or more developer accountability. Early investors who understand this shift will be ahead. This legal verdict is not just about one failed deal. It's about the maturation of Arizona's real estate ecosystem. High growth invites higher consequences. The market that once allowed generous assumptions now demands precision. And anyone operating here, developer, investor, buyer, or city planner, must evolve. So, as you watch Arizona move through the rest of 2025 and into 2026, keep this case in mind. Every real estate decision from land deals to home listings is shadowed by legal risk. Structure your contracts carefully. Stress test your assumptions. Build flexibility. And remember, markets change. Lawsuits remind us that they often do.